Every once in a while, you see a stock in a kind of boring industry that just absolutely catches fire. And right now, that stock is Comfort Systems USA, ticker FIX. Its performance has been so insane that it's got investors everywhere asking some pretty big questions.
Okay, let's just get right to it. After a string of just unbelievable earnings reports, we're talking about a stock trading well north of 900 bucks a share as of late October 2025. I mean, a run like that, it doesn't just happen by accident. It forces every single investor to stop and ask one fundamental question.
And that is exactly the question we're tackling today. We're going to peel back the onion on Fix to really understand what's going on here. What's the business? What's the strategy? And what on earth is fueling this crazy meteoric rise? We'll look at the bull case, the risks, and what's really driving these numbers. All right, so let's start with the basics. Comfort Systems USA is a national provider of what the industry calls MEP services. Now, that's just a fancy acronym for mechanical, electrical, and plumbing. And I know that sounds, well, pretty traditional, right? But believe me, this company is in the middle of a growth spurt that is anything but. So, to put it simply, think of them as the people who install the guts of a modern building. The central nervous system, the circulatory system. It's the HVAC, the electrical wiring, the plumbing. All that critical stuff that makes a building work, but you never really see. Now, that's the foundation of their business for sure, but it is not the real story here. No, the real story, the thing that explains that jaw-dropping stock price, it has almost nothing to do with regular old construction. It's all about a massive, and I mean massively successful pivot straight into the heart of the tech world. And you don't have to take my word for it. The proof is right here in the numbers. Just look at this revenue breakdown. Almost 43% of their business now comes from tech. They're not just general contractors anymore. Oh no. They've become the go-to specialists for building the absolute backbone of our digital world. And that means one thing above all else: data centers. And talk about being in the right place at the right time. They are riding three of the biggest economic waves on the planet right now. First, you've got the AI and cloud computing explosion, which is fueling a once-in-a-generation boom for data centers. Then, you've got the whole push to reshore advanced manufacturing. And on top of that, the massive shift towards electrification and decarbonization. It's a perfect storm of demand for what they do. Okay, so the demand is obviously off the charts. But why is Comfort Systems winning so much of this work? What's their secret sauce? Well, it comes down to a really powerful competitive advantage, what investors call a moat, that keeps competitors at bay and their profit margins high. And that moat has a name: modular construction. Seriously, the best way to picture this is like they're building with giant, high-tech Lego blocks. Instead of having a bunch of people on a messy, chaotic construction site trying to piece together super complex systems, they build massive, finished sections of a building inside a factory. And this just lays it out perfectly. The traditional way of building, it's slow, it's risky, a little bit of rain can shut you down for days. Their modular way, it's faster, it's safer, the quality is higher, and it's way more predictable. Now imagine you're a giant tech company building a data center. Every single day of delay costs you a fortune. For you, this isn't just better, it's an absolute game changer. But here's the kicker. This is the big one. This modular method can cut the number of workers you need on site by up to 84%. 84%. In an industry that is screaming for skilled workers, I mean, there's a massive labor shortage. This isn't just a nice-to-have efficiency. It is a direct solution to the single biggest problem plaguing the entire construction industry. Okay, so the story is fantastic, right? The strategy makes sense. The competitive advantage is super clear. But as an investor, you got to say, show me the money. So let's look at the hard numbers and see if this is all paying off. First up, let's talk backlog. That's basically all the projects they've signed contracts for but haven't finished yet. And right now, it's at a staggering $9.38 billion. What that means for an investor is incredible visibility. They basically know what their revenue is going to look like for more than a year into the future. And it's not just that the backlog is huge. It's the growth that's mind-boggling. Look at this, a 65% jump in a single year. That's almost unheard of. It tells you one very important thing. Demand is coming in faster than they can possibly handle it. And when that happens, it means you have serious pricing power. And that pricing power, well, it flows right down to the bottom line.
Check out their operating margin, a record 15.5%. This is the proof that these high-tech projects aren't just about big revenue numbers. They are ridiculously profitable. And another thing that's super important to remember is that this isn't some overnight success story. This incredible growth we're seeing today is built on a rock-solid foundation. This company has generated positive free cash flow for 26 years in a row. 26! That tells you they are disciplined, well-managed, and just a flat-out cash-generating machine. All right, so the story is amazing. The numbers are off the charts. Which brings us, as investors, to the big question you always have to ask with a stock like this. Okay, what's the catch? Where's the but? What are the risks here? And of course, the elephant in the room is the price tag, the valuation. After a run like this, you have to ask yourself, is all the good news already baked into the stock price? Maybe even too much good news? Let's take a look. So when you stack Pfizer up against its closest competitors, yeah, it's expensive. It trades at a big premium. It doesn't matter if you look at the PE ratio or the price to sales, the market is basically saying, we believe in this company so much that we're willing to pay way more for it. Now, that's a huge vote of confidence, but it also means expectations are sky high. That's a really high bar to keep clearing quarter after quarter. And one of the big reasons for that premium is also one of its biggest risks. They call it customer concentration. Think about it. With over 40% of their business coming from tech, they are really, really dependent on the spending habits of a few giant tech companies. What happens if just one or two of those behemoths decide to pull back on building new data centers? That could hit their order book and hit it hard. So beyond the price and the customer risk, there are a few other things to keep an eye on. First is execution. I mean, can they really handle a $9.38 billion backlog without something going wrong? That's a huge operational challenge. Second, are these amazing 15.5% margins the new normal or just a temporary peak? And finally, you can't forget that at the end of the day, this is still tied to the construction cycle. What happens if the broader economy hits a rough patch? So it all boils down to this one massive question. Is Comfort Systems a truly transformed company, a high-tech player that's essential to our digital future and is worth every penny of its premium price? Or is it still just a cyclical construction company that happens to be riding the wave of a lifetime? How you answer that question is everything when it comes to figuring out where this stock goes next.